Scene script. Have you ever wondered how to make your money work for you? Welcome to the world of passive investment, a strategy that enables your money to grow over time with minimal effort on your part. Imagine you're planting a tree. You sow the seed, water it, and provide it with sunlight. Then you step back and let nature do its work. That's passive investing in a nutshell. You invest your money in a specific type of fund, like a market index fund or an exchange-traded fund, also known as an ETF, then sit back and let your money grow. Now here's the interesting part. These funds follow the performance of a specific basket of stocks. This could be a broad market index like the S&P 500, which includes 500 of the largest US companies, or a sector-specific index that focuses on a particular industry. The beauty of this strategy is its simplicity. You don't have to be a Wall Street wizard to make it work. All you need is patience and a long-term perspective. You're not trying to outsmart the market or pick the next big winner. You're simply riding the market's waves, confident in the knowledge that historically the market has tended to rise over time. Now don't get me wrong, passive investing doesn't mean you're being lazy or uninvolved. You still need to do your research, choose the right fund, and monitor your investments. But once you've made your choice, you're not constantly buying and selling. You're holding on for the long haul, letting your money work for you. Passive investment is about balance. It's about taking a step back and letting your money grow with the market. It's about the power of compounding, where your earnings generate even more earnings. Remember, this is a long-term strategy. It's not about getting rich quick. It's about building wealth over time. It's about being patient and persistent, knowing that the journey to financial freedom is a marathon, not a sprint. With passive investment, your money grows with the market. It's about steady growth, not overnight success. So why should you consider passive investment? Let's dive into the numerous advantages this strategy offers. First and foremost, passive investment is known for its lower fees. Unlike active investing, where high fees are often charged for the management and frequent buying and selling of securities, passive investing minimizes these costs. How so? Well, passive investing typically involves buying and holding a diverse mix of assets, which significantly reduces transaction costs. No need to pay hefty fees for a fund manager's expertise or the constant trading of assets. It's a strategy that keeps more of your money where it belongs, in your pocket. Speaking of a diverse mix of assets, let's talk about the second advantage: diversification. Passive investment often involves investing in index funds or ETFs, which are designed to replicate the performance of a specific market index. This means your investment is spread across a wide range of securities, mirroring the market as a whole. And as the saying goes, don't put all your eggs in one basket. Diversification reduces the risk of your investment being severely affected by the poor performance of a single security. It's a safety net, providing a level of protection against market volatility. Now let's address the third advantage: the less time required for managing investments. Active investing requires a lot of time, knowledge, and effort. It involves constantly monitoring the market, conducting research, and making frequent buy and sell decisions. But with passive investing, once you've set up your portfolio, it largely takes care of itself. It's a set-and-forget strategy, making it ideal for those who want to invest, but lack the time or knowledge to manage their investments actively. Finally, it's worth noting that passive investing is not about beating the market. It's about growing with the market. This approach allows you to reap the benefits of long-term market growth without the need for constant decision-making or stress over market fluctuations. Passive investment allows you to participate in the market's growth without the stress of day-to-day management. It's a simple, cost-effective, and time-saving strategy, and those, my friends, are the key advantages of passive investment. Scene script. Ready to get started with passive investment? Let's get into the nitty-gritty of it all. The first step, like with any other venture, is setting clear financial goals. Ask yourself, what do you want to achieve with your investment? Whether it's saving for retirement, a down payment on a house, or a college fund, having a clear objective will guide your investment decisions. Next, you'll want to choose an appropriate index fund or exchange-traded fund, abbreviated as ETF. These are the heart and soul of passive investing. Index funds and ETFs track a specific index, like the S&P 500, and allow you to diversify your portfolio without the need to purchase each individual security. These funds are designed to mirror the performance of the index they track, providing a broad market exposure with low operating expenses. Now here's where the rubber meets the road. Regularly invest a fixed amount of money. This is often referred to as dollar cost averaging. It's a simple yet effective strategy where you invest a certain amount of money at regular intervals, regardless of the market's performance. This approach not only minimizes the impact of market volatility on your investment, but it also removes the need for you to time the market. And most importantly, patience is key. Remember, Rome wasn't built in a day, and neither will your investment portfolio. The beauty of passive investing lies in its long-term approach. It's about consistency, not timing. It's about letting your money work for you over time, taking advantage of the power of compound interest. To sum it all up, starting with passive investment involves setting clear financial goals, choosing an appropriate index fund or ETF, regularly investing a fixed amount of money, and above all, having patience. It's not about getting rich quick. It's about building wealth slowly and steadily. Remember, passive investment is a marathon, not a sprint. But wait, isn't passive investment just for those who don't know about investing? Now that's a question we hear quite often when it comes to passive investing. It's time to debunk some of these common misconceptions. First off, let's tackle the myth that passive investing is only for novices. While it's true that passive investing can be a great starting point for those new to the investment world, it doesn't mean it's strictly a beginner's game. Some of the most seasoned investors utilize passive strategies. Warren Buffett, one of the world's most successful investors, has even recommended index funds, a common form of passive investment for both novice and pro investors. Next up, there's a belief floating around that passive investing doesn't yield good returns. This couldn't be further from the truth. Passive investments, particularly index funds, have consistently matched or even outperformed their actively managed counterparts. According to a report by S&P Dow Jones Indices, over a 10-year investment horizon, 85% of large-cap fund managers failed to outperform the S&P 500, a popular benchmark for passive investment. Another misconception is that passive investing is a set-it-and-forget-it strategy. While it's true that passive investing requires less hands-on management than active investing, it doesn't mean you can ignore your investments altogether. Regular reviews and rebalancing are still needed to ensure your portfolio continues to meet your financial goals. Lastly, there's a notion that passive investing is inherently riskier because it lacks the active management that can respond to market changes. This is not necessarily true. Passive investing is about long-term growth, and while it does expose investors to market fluctuations, historical data shows that markets tend to increase in value over time. So there you have it, folks. Passive investment is not just for beginners. It can yield impressive returns. It's not a set-and-forget strategy, and it's certainly not riskier than active investing. Passive investment is a smart strategy, not a fallback option. Let's quickly recap what we've learned about passive investment. Passive investment, as we've discovered, is a strategy that aims to maximize returns over the long run by keeping the amount of buying and selling to a minimum. It's like planting a seed and letting it grow over time with minimal interference. This approach is based on the concept that markets are generally efficient, and over time, they'll provide a good return on investment. We delved into the myriad of benefits that come with this strategy. One of the key advantages is the cost effectiveness. By trading less frequently, you'll incur fewer transaction fees and reduce the tax impact. Moreover, passive investment allows you to enjoy the fruits of market growth without the need for constant monitoring or predicting market trends. It's a strategy for those who believe in the power of patience and the magic of compounding. We also discussed how to get started with passive investing. The first step is always to define your financial goals and risk tolerance. Then you can choose a diversified portfolio that aligns with these goals. Key tools in this journey include index funds and ETFs, which offer broad market exposure and are ideal for passive investment. We debunked some common misconceptions about passive investing too. It's not about sitting back and forgetting about your investments. On the contrary, it requires regular check-ins and rebalancing to ensure alignment with your financial goals. Neither is it a guarantee of instant success. Like any investment strategy, it has potential risks, and it's crucial to understand these before diving in. Investing passively doesn't mean you're passive about your financial future. It's about making smart, strategic decisions for long-term growth. Remember, the tortoise won the race not because he was the fastest, but because he was steady and persistent. So plant your investment seeds today, tend to them periodically, and watch your financial garden grow over time.